Hey guys, welcome to Gold Rush Live. We have a special guest with us today is Josh Young. Very excited to have Josh on here with us today. He has just launched Bison Insights, which is going to be where he puts out his research. And so this is going to be very interesting. He's talking about natural gas already. Saw a great video from him. I saw like your first trade was put out from you guys just I think today or yesterday. So a bunch of interesting stuff happening from Josh, but most importantly, Josh is just a great energy analyst, one of the best minds in the energy sector. And also, when we're looking at fundamentals, like he's the guy I go to because most of the time, like you get a lot of froth in the energy space, and Josh is always very balanced, and he kind of knows exactly what he's looking for and where to dig to find good value. So, how are you doing today, Josh? Glad you're with us.
Good. Yeah, thanks. I appreciate it. Yeah, like we were talking about before turning this on, getting, juggling a lot of stuff. So it's a good moment to be on. Lots of stuff happening in the energy market. So, really, really happy to be here.
So tell us a little bit about Bison Insights before we get on. Like, tell us like why you decided to launch it now, where people can find you, and so on.
Yeah, sure. So where you're catching yourself. I'm the portfolio manager for Bison Interests, which is an investment fund advisor, and we invest in publicly traded oil and gas companies, and have done that for over a decade, and I think have done quite well, at least relative to various benchmarks. None of this is an offering for that or anything like that, and what we found is that in the process of building a media presence and sort of marketing Bison interests and letting people know about it, we figured that there was actually a market for that. It seemed maybe even more than for this sort of investment advisory business. And so what we're trying is I launched this separate sort of media business essentially to share oil and gas market analysis and share some of the investments that I'm personally making that aren't recommendations for anyone, but just sort of signposts. And I guess if I have just a few more seconds, the reason for that partly is I have this, at least you can see sort of part of it in the frame, this article from Barron's where, at Bison, at the investment strategy I was running, we were up over 1,000% from November 2020 to around June 2022 net. And no one could figure out what we did. And I did sort of a bad job of explaining it, I think, while it was happening. And then, it's been a couple of rough years in the oil market, especially with the sort of small caps I like since then. And so I realized that sort of just having a separate sort of media mechanism to go and just explain what I do on a sort of idea by idea basis would be a great opportunity to sort of help people see what's going on, teach people something, and sort of have a different sort of approach towards things. So that's Bison Insights, and literally, like you said, just launched. We put out one thought piece on natural gas and sort of what people are missing in that market. And you guys know a lot more about the shorter term trade stuff, what's going to happen next day, next week. But over the next few years, natural gas in the US looks amazing. And then we shared one of my favorite ideas that's like the joke is it's easy to value and hard to buy. And so that one just to show sort of, hey, there are these crazy things just sitting there that no one will talk about. And so, hopefully have a bunch more to go on the natural gas side and then coming up in the next few months with some oil ideas too.
Yeah, no, I love it because long term, that's where I really sit as a trader. Sam's very good at like more of the short term swing trading stuff, and long term, Sam does it all really. But like, I really think the big picture here is the commodity cycle is still has legs. It would be the shortest commodity cycle in history if we just had from 2020 to 2022. And I love that you brought up that period of time because I remember sitting in 2021. It was the end of 2021, and I was hanging out with a bunch of other hedge fund managers, and they were all talking about how they had a terrible year that year. How hard it was to trade that market and so on. And I'm sitting over here like it was still, I think it was my best year ever. And I'm sitting over there going, how was it a bad year for everybody? And I go, oh, they were just buying, the Mag 7 basically. So can you speak a little bit to the fact that, how good it is to kind of look outside of the technology sector and into some of these other sectors that are unloved, undervalued, very small weightings in the S&P 500 these days, like if we're looking at oil and gas, if we're looking at natural gas, even uranium. I know you cover a lot of different commodities, but what are you seeing out there? Do you think that energy could ever become a large part of the S&P 500 again?
Yeah, I mean, there's a lot there in what you said, and yes, generally I agree. It's funny, we actually have a thought piece we're going to put out in the next month or so on the problem with sort of the current market structure and how small market exposure is to upstream oil and gas producers versus the history of those producers, and then how much money they make versus how little market exposure people have in these sort of indexes that they're using to get their public exposure. And then even more so on the private side, where there's almost no money in oil and gas relative to the history of money that's gone in on the private side. And so, yeah, I think there's some real structural issues that other folks I think are way more articulate than I am about, hey, this is what happens if energy is 3% of the S&P 500 as a percent, but it's 10% of the earnings. And then if you look at upstream, it's like 1% of, let's say, S&P 500 or, Russell 2000, whatever. And then it's, especially in a smaller cap, it's like 20% or 15% of the earnings. And so, various folks have different theories on how these things break or what happens. And I'm not really a doomer. I think getting back to sort of the first thing that you had just said which is that this would have been an astonishingly short commodity cycle, and I've gotten a lot of flack for, hey, why didn't you sell in June of 22, right? You were up huge, like massive wealth creation. Why not just cut and run? And so, again, from a trading perspective and from, the last few years sort of enjoyment perspective, it definitely would have been more enjoyable to have sold. The problem was that we looked at the rig count increase from the bottom when oil went negative in, was it March of 2020 to the top where actually the rig count kept increasing even after the oil price started to fall into early 2023. That rig count increase and like where the rigs were going and what they were doing was insufficient to be able to supply necessary oil and gas over the next 5 years. And so it's going to sound weird to people to hear that because the rig count has fallen since then and production hasn't fallen. But the important part of that is it hasn't fallen yet. And so the delay and sort of misunderstandings about some of what's going on have led people into, I think, pretty much the deepest despondency that we've seen in oil and gas in my career. I think it's actually worse than 2020 because in 2020, everyone was like, oh, well, there's lockdowns now, but everything's going to recover, whether it's a year or 3 years, it's going to recover. Here, people are they've given up. And even like the Bloomberg like analysts, I posted about this on X today, and it's sort of amazing how wrong they've gotten various like big, strong calls, which is weird for like a newspaper or media company to have those sorts of calls. But they've gotten like over and over again, like presented beginning of this year, hey, there's this super cycle for what was it, coffee, and shows this like reporter like drinking coffee and talking about coffee prices are going to rise for years, and there's basically nothing that will disrupt it, and coffee prices just like straight down basically since then, since like that February 25. Similar issue with cocoa, and that same analyst reporter whatever is like, oh, like oil can't go up. And then he said the most amazing thing, which is it definitely can't go to its all-time high. It definitely can't. I can't say it can't, but it definitely can't. It's like, oh, this is amazing. It's not quite as well known as an indicator, I think, as like the Economist cover or whatever. But when someone says it can't and they like try to present something without sort of a full explanation, it's probably actually going there. And so again, insufficient investment, particularly on the sort of earlier cycle stuff, the exploration and delineation that you need to have the sort of production that you have now. And when you spend too much time harvesting what you planted essentially many years ago and not enough time planting again, when you go to harvest over time, it gets harder and harder and you start having more and more issues. And so again, I think this is just amazing setup for oil and gas. There wasn't enough investment even at that sort of peak in 2022. And now here we are with way less investment way more bearishness. And it's amazing. I mean, you find these things and it's like, oh, someone was debating me about this like latest like this I guess first stock pick for Bison Insights. It's like, oh, is this asset worth this amount? And it's like, well, maybe it's worth a little less right now and a little more then, but we're debating whether this is a 3x right now or a 2.5x or a 3.5. Like, okay, cool. You can be right on this one, on this aspect of it, and there's still just so much upside. And that's on an individual company, but as you look across these sectors, again, this may sound like really hand wavy, but it's really simple. If you don't explore and you don't replace reserves, when you go to produce reserves that don't exist, you can't produce them. And so when you try to produce your 105 million barrels a day of demand, and you don't get that number, then, we had a 3% oversupply that sent prices negative. Something like that in 2020. It ended up actually really being for the year, a very small percent oversupply for that year. What happens when there's a 3% undersupply for a year? What happens to you? I mean, does it go vertical and sort of where's the limit there? So anyway, that's my response to that.
Yeah, Josh, I was curious what you learned from that post-COVID energy bull market. For me personally, it was really it comes down to the old John Roque quote, who was the market technician for George Soros back in the day. And he says, we're not in the mean reversion business. We're in the mean reversion beyond, we're in the moving beyond the mean business. We don't just go to the mean. Energy was so far below the mean back then in 2020. Prices went negative, Josh. That was absolutely insane. You've been in this game for a long time, and I'm sure that even surprised you. Like
Yeah.
I didn't know that could happen. Like that was really bizarre. And then after that happened, you went so far beyond the mean. It was an incredible performance. You said you were up 1,000% during that 2 year span there. Like that must have been awesome. Like, and we don't want to confuse brains with the bull market around here, but you crushed it. So, what did you learn from that? Because we're probably going to see that again at some point. You mentioned that. Sentiment is down in the dumps right now. Valuations are dirt cheap in energy. Nobody wants this stuff. It's pretty clear that we're below the mean. So whenever we do go beyond the mean, which is, in my opinion, inevitably going to come, we want to be prepared for it. So how can we capitalize on that whenever that comes?
So someone asked Druckenmiller about what he learned when he went all in on tech in like February of 2001, right as it was about to, or February 2000, right as it was about to implode. And he's like, I knew better and I just couldn't help it. And I learned nothing. There was nothing I didn't know already. And so I'd say 99% of it that was true for me. I think the one thing that was very weird, and I guess you guys might particularly appreciate this, there were some folks that started showing up like paying PR people to get on TV with like sort of weirdly not like this background. There's just my like bookshelf and whatever, but like similar to like sort of old setup I had, and like saying things that were sort of like copying stuff from like my white papers, and had these like very weird things where you'd see newspaper articles and they'd correspond, like 8 out of 10 words would correspond with like emails we had sent out to clients or put on our website or whatever, but in XYZ major publication over and over again. Those are scary signs that I did learn. When that happens, the next time I will start selling aggressively and not investing again until everyone hates me and hates that stuff all over again. So that to me, that was a very weird thing. And I thought it was just the slingshot process where we were going from like, crazy low sentiment to normal. But that was, I think, there was a little bit of froth and weird stuff. And so, when you get that froth and weird stuff, that's a good sign to start selling. And then the flip side is, look, like in April of this year, similar to, let's say November 2020 or March 2020, there was like real capitulation. You could tell people were like mad that, anyone who had been invested in oil was an idiot and evil. Anyone that told them, hey, maybe this stock is interesting, whatever, those are the points where, I don't use leverage. I'll occasionally buy out of the money calls or something with a very tiny percent. Um, and my portfolio actually mostly is risk management, so that way I can hold some cash and still actually have exposure. But I'll add a little to stuff like that in situations where there's just extreme, that like real severe like negative sentiment is, pretty good, I think, as a risk measure to go extra long risk. And then when people start, I mean, again, I guess I was sort of uniquely positioned for this. I could tell they were using my work and like my words, and in some cases my image. And there was this one company actually a couple years ago that literally took a video of me talking and tried to use it to promote their garbage SPAC nonsense. So anyway.
That's really interesting. You guys out there listening, this is one of the best fundamental analysts in oil and gas, and he's telling you that at the extremes, he uses technical analysis. He studies the behavior of the markets and the market participants. So, for what it's worth.
Well, I
Yeah.
think
I
we
mean,
all
like,
do.
to be fair, everyone does that, right? Like whether or not they admit it, everyone does that. And that's where I think the like lines on charts thing gets a lot of negative rap, but the awareness of like what game you're playing and who you're playing with, everyone does that. Every fundamental analyst does it. Every private equity firm that says that they're just doing their models and their whatever, everyone does. You need it, right? It's like how you do business, right? You negotiate a deal to buy a building or to negotiate a lease or hire someone. There's always situational and people awareness. So if that's technical analysis, absolutely,
That
I'm
exactly
a
is. Yeah, I love that you bring up drawing lines on charts because, that's what beginners think that technical analysis is. But really, at its core, it's just studying the behavior of the markets. And a lot of times, charts are a great way to visualize that behavior. But it's not just that. It goes back to like those crazy articles that you were talking about. If you see some crazy economist article that's super bullish on energy, you probably want to think about selling your energy stocks, things like that. It's not just drawing lines on charts.
Yeah. And there is one other thing I didn't mention, which I think it was the other factor for not selling in 2020, or sorry, 2022. And I think it's coming in a big way. And it's sort of a nuance to what I was saying before. The small caps did not trade up how they would need to, I think, in order to be able to end a bull market in energy. And I guess this is full on technical, right? We did the analysis on the fundamentals on these things where, hey, like, the small caps were as well positioned as they were at the start of major bull runs in 2022, not even 2020. They were really well positioned, very low cost structures, and people got really mad about this analysis. We got like one or two very minor things wrong. And again, we always try to improve stuff. Everyone gets stuff wrong, but they were like, oh, that means this is not true. I was like, well, okay, here we fix the error, and oh, it's still true. Good to know, and let's move on. But we think that you need to see a not just an improvement in the percent price or price movement for these small caps, but we need to see these small caps and the services companies at large premiums to large caps, because that's where the production growth comes from. That's where the growth comes from. That's where the discoveries come from. And you need those things in order to push from a bull market, which is an undersupply for a commodity, to a bear market, which is an oversupply for a commodity. If you never get that sort of overinvestment impulse and impetus, then you just don't get into a bear market. I mean, you look at what happened, the most recent one, the 2000 to 2008. I mean, it took oil going from 10 to 150 to get into a blow off top, and then to have that oversupply for oil. And even then, it took years of $100 oil before you got into a real oversupply situation in 2014. So the one other thing that I think is a little scary about all of this, that makes me really hesitant to want to go sort of fully liquidate in a sort of similar scenario to like 2022, is the 1970s scenario, where when you look back and you say, hey, what happens if you have a decade of underinvestment? Right? The 1960s was real tough for oil and gas. Like there was a boom period. The Nifty 50 were great. They're sort of similar to Mag 7, market concentration and breadth and so on. I mean, it was very similar. I mean, we're in a more extreme time frame now, which is again even scarier. But you look at what happened in terms of low investment, low exploration, and so on, in the 60s leading into the 70s, and then failures of discoveries and falling rig efficiencies, which is some of the stuff we put out in this gas analysis. Um, and what you got in the 70s wasn't a boom bust. It was a boom, oil up like 3 or 4x and then down 50%. And then it sort of stuck around and then up another 3 or 4x in the late 70s and then down a little. And then eventually had enough investment. So the risk is you get too excited about a move up. You say, hey, this thing has been dead for a while. So, oh, we're up a few 100% or whatever off the bottom. In the equities, we're up 50% or 100% off the bottom in the notional and the commodity, and we're done. And the problem is that's how it ends sometimes. And that would be like a normal bull market. But when you have these really long underinvestment cycles, often it doesn't resolve in a week, a month, a year. It often takes a multi-year resolution period. So anyway, that's the long answer for what do you do? How do you navigate it? And I learned nothing.
Well, let's talk about, you're talking about bull markets and bear markets. And Sam, can you bring up slide 9? And so this was something that you mentioned just a second ago, and I remembered like I brought this chart. It's kind of interesting, but I wanted to pick your brain on this a little bit. So when we're looking all the way back at, like you said, I think it was 99, and there was every cover had oil under $10 a barrel. That was a huge thing at the time, and that was the bottom basically. And then we saw that massive rally that happened, like you said, into '08. And then we get the same kind of thing setup happens in 2020. Oil prices front month of contract goes negative. Then we had that huge rally through the Russia-Ukraine war. So, I want to talk about this so people can get a learning lesson from you today. So when we're looking at oil price hitting single digits, what are we looking at out there for producers? Are they out there drilling for more oil? Are they out there going, is everybody kind of not drilling at that time? And then what are we looking at these tops when we see, oil hitting $150?
Yeah, sorry, I took a second to comment. This is the inverse for oil price, right?
Yes. So it's
Sure.
a
Yeah,
Dow Jones to crude oil. So
got it.
oil hitting single digits and is the 99 or under
Excuse me.
$10. And then the $150 is where great financial crisis is.
Yeah, okay, I see this. Yeah, so what I mean, look, like you look at this and you think, hey, maybe there's this like gravity that's going to sort of suck oil up even more into some sort of terrible crash. And then, I mean, that's just like the way, that's what I see, the first thing I see, the way this is set up. I'm not sure I buy that so much.
This isn't
Um,
that exactly. So I'll explain the chart a little bit. But
okay.
the danger zone area is basically the point where oil gets to that point where there's a lot of resistance. There's some reason that usually comes into play that we usually see the oil price go up. Right now, the Dow Jones is so high and equities have performed so well that it's surprising to see it all the way up here. With and oil's at was at $60, I think, 55 at its lowest. So it's surprising to see it up here. So this is basically just showing like the Dow Jones compared to oil doesn't usually get over this blue line. So it's actually fundamental or technically saying that oil prices are probably going to go higher. But my main thought for you was, are we looking at, these scenarios where we see oil prices going negative or oil prices hitting single digits? Are people out there still drilling for more oil, or is this because I want to explain the commodity cycle to people from your angle as a fundamental guy, like understanding like people, if oil is basically at these very low prices, there's not a bunch of people out there going to get more oil. And if oil is at very high prices, everybody in the world's looking for it. So is this something you kind of look at, and are you looking at this right now?
Yeah, I mean, I don't normally look at the oil price versus various stock indexes. It's a very interesting perspective. I'd have to think more about what this means for capital investment. When I think about just sort of the pure oil price on an inflation adjusted basis, um, and then, I think there's sort of a few factors to combine to look for where you're going to have underinvestment and undersupply. And so, just very simplistically, yeah, you look at this and you say, hey, when was there so calamitously little investment that we ended up with this huge bull market in oil, right? And so you show, now that I'm looking at this more closely, so you show this like 98. '99 sort of peak for the market versus oil. And that was a period where there had been underinvestment and it got extreme. So very, very few companies were drilling, activity was down. One of the really interesting things is typically activity goes down while well productivity goes down too. And so that's part of why it matters so much that these reservoirs that the companies are drilling into that are already discovered, that have been discovered for a long time, that their well productivity is falling on a per foot basis. The rock itself is less good. That happened um, in um, in the 90s, right? You ended up with well productivity falling a lot. It was sort of the end of the North Sea. It was the end of sort of conventional to some extent in West Texas, various other places. And the opposite of that was in 2008, where you had a lot of these big offshore discoveries that were just coming on production. You had like the big stuff in Brazil, the pre-salt was discovered around then. You had shale discovered and starting to come up and well productivity starting to improve. So yeah, so you have activity fall in low prices, but also typically you end up with like low price almost capitulation right at the point where you need a lot more exploration and investment and you're not getting it. And it's that combination of like less supply, but also less sort of restocking to be able to get supply in the future. I think it's that double shock that sort of forces prices much higher. Because commodities are truly competitive, so in theory, the pure sort of classic economics, they should compete to zero profit. But the problem is that that competition process is very imprecise from a time perspective, and it's clumpy. So you end up with big clumps of sort of excess production and negative profits, and then you end up with insufficient production and really high profits. And so they sort of go together. I think it's like a little, I'm still thinking about what this chart really means. So
No, you
I
nailed
think I
it.
went a few different directions.
No, you nailed it. That was really what I wanted to talk about was the cycle, the big thing with the cycle. And so, let's Sam, can we go to chart 10? So this is another thing. Josh and I nerded out about this. So we went on a podcast and just nerded out about it. I think we kind of took it over for about 20, 30 minutes, but
Oh, I
just
love this
talking,
chart.
yeah, just talking about like the commodity cycle, and this is the why I wanted to start there with oil is like just understanding its supply and demand, like understanding what we're actually doing here in the commodities market. And this is just a chart, and I'm always looking at cycles. I had my great great uncle who was a cycle style trader. The picture that's behind me that I always talk about. When I look at this chart, it's just kind of telling me where we are in the commodity cycle. Is it a situation where we're seeing oil take or gold take off? Yes. Okay. What's usually next after that? Usually copper, usually oil. And so, Josh, when you think of this fundamentally, what do you think is happening? What do you think drives this style of a cycle?
Yeah, yeah, we've talked about this. I think it's definitely worth spending a little time on. So, um, I think the best way to understand this chart in the context of sort of contemporary economies and politics is that things start to get bad, and so the government starts to print money in order to make, their citizens less likely to riot and, violently throw them out. And so the governments start to print money and that money printing, depending on who you ask and how you measure it, is either front run by gold or gold prices rise following that. And I think in different cycles it sort of depends exactly. So you get the money printing and you get gold, which is sort of a pure play just on inflation and currency debasement. And then, as a part of that money printing, government spending is extremely wasteful and inefficient economically, but you still end up incentivizing some economic activity, and you end up with copper prices rising. And then, there's some interplay between gold and copper too, in terms of when you drill for gold and then mine for it, you often get a lot of copper. And so there's some complexity there, but I guess I'm trying to just sort of simplify it. So you have the money printing first hits the inflation, the pure play and currency debasement, then it hits some economic impact. And then it turns out that doing anything in the economy that's real, that's not like, sending each other like emojis that cost money or like, whatever, takes a lot of oil. And even with EVs and all this other stuff, I mean, and now it's these days it's like it takes oil and natural gas and uranium and various other energy inputs. But um, even mining copper takes a ton of oil, and then mining gold does too. And so you have these cycles where you basically have the money printing cycle, and then you have the economic cycle, and then you have the boom bust of the oil cycle. And the coolest thing about this, when I looked at this closely, and this was, I decided to like really highlight this on X and really like, I just thought it was so interesting to see. So diesel right now has been in demand. The premium for it's come off a tiny bit, but it's been in demand more than literally every investment bank and forecaster thought by a lot this year. By a lot. And like, you'll have the Bloomberg guys just like doubling down on their bearishness. A lot of the folks are, but they're just completely ignoring it. You'll have other folks talk about it and then try to explain it away. But it's just right here, right? It's like why would diesel be doing well right now in the cycle when trucking is doing poorly and shipping is doing poorly? Well, you just look, gold mining and copper mining are immensely diesel intensive. I mean, it's like one of the biggest incremental swings in diesel activity other than trucking. And, I say diesel, but, you can use fuel oil for ships and so on, and very similar in the refining sort of setup. So, anyway, I think this is exciting. Other than sort of the tariff mess and stuff with copper, you have pretty good copper prices. Are we at or near all-time high gold prices? And so you have, I mean, I keep seeing these like mining companies issuing shares, and like Sprott's stock is at all-time highs. I mean, see, you see the makings of huge demand for diesel for mining from a mining boom. And so whether we're actually consuming it or whether people are starting to stock up on it to use or the market's just front running it, I'm not sure which, but we're in this very interesting cycle where we have gold tying to copper, like you're showing, tying to oil, and where people are just going to be surprised. They're all trying to use the same supply demand models, and they're all forecasting, and no one is sandbagging, hey, maybe it's going to take 6 months longer to bring on this production or whatever. And no one's considering, hey, maybe demand for oil picks up for mining or for various other things before we get the all clear signal for the economy. So anyway, that's what I see here. But what do you see?
No, I love it, and because that was the thing, I love these charts because it just kind of tells you like what we're kind of looking at, and the way you explained it is perfect. It's the same way I think about it, which is we have the money printer, it goes crazy, then you kind of see oil do something, or sorry, gold do something, and I just think it just illustrates the way the cycle works more than anything. Now, once again, it's a long-term time frame, so you're not sitting here and going, "Hey, I'm just going to buy oil today because it's going to work out great tomorrow." It's a gold's moving, copper's moving, oil will probably catch up at some point, and that's really all it's trying to say. And that's the thing that's interesting about gold in the first place. When you look at something like gold, and some people will remember, in our career, Josh, we see a lot of times where gold would move like crazy, but also bonds were moving with gold. And people were very confused about that, going, okay, gold only moves up in inflation. What the heck's going on? And it's exactly what you said, which is it's money printing. It's as rates are dropping, liquidity's going in the market. Just like Josh said, it's a situation where governments are trying to keep their people happy. Governments are trying to keep money loose, so the stock market goes up, and then a lot of that money sometimes goes into gold. So no, I just nothing really to add there. I just just very happy for you to explain that in such a great way because I don't think I've even articulated it that well. So thank you.
I
Wow, there
actually
was a
had a
lot of hand
question on
waving there.
this.
Sorry.
Hey,
Kind
go
of
ahead, Josh.
tying into money printing. We talk an awful lot around here about how like it seems like the evidence is pointing towards a 40-year bull market in bonds ended in 2020, and bonds probably aren't going to do well for many, many years. So maybe the traditional 60/40 portfolio is dead. So like from an asset allocation standpoint, Josh, do you think that's true? Do you think that bond allocation should be redirected to commodities. And, we have Wavy McFly here in the chat saying he's in some pretty high yielding energy stocks. And I know there's some tremendous dividend yields you can get with these energy stocks. So, they can go sideways for a few years in absolute terms, and you can just collect that dividend. And I think that is a really interesting idea from an asset allocation standpoint. What do you think about that?
Yeah, so first of all, I used to think like that, and then I learned that when I see a high dividend yield, I immediately think risk. And so, there's always that's the first thought. It doesn't mean that there isn't sufficient reward to outweigh that risk, but that's my first thought. I owned a stock in this company that was supposedly really stable and really whatever, and people loved the board and loved the management team, and then they just, lied about stuff and messed up, and prices went down. And as they reduced their dividend and then cut it outright, it was just a mess. And then of course they awarded themselves giant amounts of stock and did a stock plus warrants deal at a price where they didn't make it available to their shareholders or anything like that. And now it's back up and people like it again as a high yielding stock. So that's my particular story of why I don't like that specific thing. Is what it is. So about bonds, the problem I have with that theory is that um, I think there's a good chance that we end up seeing yield curve control again, and that we end up seeing just QE infinity round two or three or whatever it would be. If you look at the stuff that Trump is doing right now with the Federal Reserve, like it does seem pretty likely that's going to happen. And so what I think happens here, and I don't know for sure, and again, this isn't really fully my world. I'm have a degree in economics. I think I understand economics, but I definitely don't have a degree in crystal ball forecasting. But it appears the trajectory is towards devaluation of currencies and maybe synchronized devaluation with a number of major currencies rather than letting high yield or letting 30-year bonds or whatever go too high. And the other part, again, I don't know that it's necessarily rational economic policy, but the current president of the United States is a real estate developer and levered commercial real estate owner, and I guess residential real estate owner by profession. And so the thing real estate owners always want is declining yields in order to get appreciation on their properties. So whatever can be done politically to do that will be done. And again, it's not that it's impossible to force yields lower. It's just when they should be higher. So maybe there should be a 40-year sort of increase cycle. There's just always a cost. And so I think their thought is the cost will be that they'll do it, they'll force it, and then there will be, tremendous devaluation of the dollar.
Yeah, that's a great question, Sam. And it kind of segues into when we're looking at, so we're talking about Trump, we're talking about the Fed right now. So I have thoughts on lowering rates, like if we kind of came in, like everybody keeps asking about, okay, what's going to happen to this commodity cycle if, somehow, let's say Powell's out, let's say Powell caves and lowers rates, however it goes. Do you think lowering interest rates by the Fed, meaning the front end of the curve, would actually kill the commodity cycle, or do you think it would make it take off?
I don't know that the front end matters that much for commodities. I think there's a risk that, a number of economists and forecasters and stuff I have read stuff from or listened to say that if they lowered the front end, that it actually could risk raising the long end. So if that were to be the case, that would actually be very economically destructive because the short end is where like the developers borrow and the long end is where the consumers borrow. And so, on mortgages for homes and various other sort of major purchases. And so I think if they're going to do it, they're going to probably try to do both. And I don't know whether they'll do one and then the other or both together or whatever. But yeah, I don't know. I don't know what would happen exactly if they lowered the short end. And it does appear that there's it's not just me saying this or seeing this. It does appear, when you hear even like Trump talking about they need to lower rates, he says they need to lower the Fed rate and then mortgages are too expensive or some other thing like that. And so he clearly does not mean just the front end of the curve being lowered. And again, like what's that mean policy wise? And is it terrible or good or whatever? That those are value judgments that, I just care about I mean, I would like good policy, but I care about the likely path and then the economic implications. And again, if that were to happen, what I would see is a consequence to the dollar. The very weird part is it's possible if that we go down that path that the DXY actually appreciates instead of depreciating. I know it sounds weird, but we're like the least bad of the major currencies. If we do that, like Japan has been chomping at the bit for years to go do yield curve control. It was their whole thing, how they propelled their economy. Instead of taking their pain after their bubble in the 80s, they just sort of put themselves in limbo and stasis for like 30 years. So, and they did it through yield curve control and through sort of monetizing their debt. And so Japan would love to do that. Europe has a very sort of socialist, aggressive, government spending policies. They would love to do that. So you'd end up in a weird situation, I think, where the US would do it, others would do it, and everyone would devalue their currency. And that's the explosive case for gold, where you get a 10,000 or whatever, like super high price for gold or higher. And that's where you could get that sort of all-time high price for oil, which again, Bloomberg says will definitely not happen. So,
So it's impossible. Is what you're
yeah,
saying because Bloomberg said it. No, I mean
yes, yes.
I love this conversation because when I'm looking, people keep asking me about the Fed and they go, if they cut rates, we're going to head into a deflationary cycle. And I keep saying, like, I really would doubt that. Like, that would be the most surprising thing that would ever happen for me, which is sitting here and watching them cut rates and thinking that that's not going to go into the market. That's not going to go into gold stocks. It's not going to go into energy stocks. Like, I think it would just send everything a lot higher. I think inflation would get completely out of control. And I think Powell sees part of that, like maybe he doesn't see that whole picture. But, if you started to cut rates, like let's say we had an aggressive cut today and as and I know, like it wouldn't have to even hit the market that quickly. But if Powell came out and said he's going to cut rates by, 1%, let's say, you'd have this explosive move in basically everything very quickly. And I like what you said about the currencies, because that's another big thing that I think is going to come into play at some point, which is this race to the bottom. And the dollar, yes, it's the cleanest dirty shirt. But at the same time, it's how quickly can we all race to the bottom is probably going to be the idea. But working together with these other countries to do it is probably going to be something as well. So I love that you brought that up, put that on everybody's radar. Let's hop to natural gas. I know
Wait.
you.
Before we do that,
Go
I
ahead,
just want to
please.
share one more thing on this while we're on this chart and while we're talking about currency debasement and other sort of. So OPEC, been in the news a lot. I got to go see them in Vienna earlier this year, which was pretty interesting to get to go
Nice.
hang out with some of the state-owned, state-controlled companies and the senior OPEC people. Actually got to sit down for almost 2 hours with the Secretary General and a couple other people, which was amazing. Like really smart, interesting guy. They're brilliant. What they're doing with all this is they're saying Trump is like, you need to produce more. And they say, yes, sir. And so they're bringing all their capacity onto the market. Everyone said, oh, they have 7 million barrels a day of spare capacity. Even they don't believe that. Like their member countries put that up, but they said, look, like we don't measure that. That's up to them to claim. I'll walk through how we analyzed it in a Bison interest white paper a number of years ago, and I thought they would have been offended. They're like, no, that's probably the most rational way to actually evaluate spare capacity without physically measuring it, and no one will let you physically measure it, so you're good. So into a potential currency devaluation, you don't want to do what they did in 73 and be seen as withholding oil, which frankly they did not. I mean, they tried to, but oil's fungible. It went right from where it wasn't supposed to go to where it was, or where it was supposed to go to where it wasn't supposed to go, and vice versa. Similar in 79, there were major devaluations happening and major changes in the commodity markets that drove the oil price in the 70s. And this not, I don't know, maybe I sound like a OPEC mouthpiece. There's lots of things they do wrong, very imperfect, but they probably weren't, they were the excuse, but not the real driver for the oil price move in the 70s. And so I think they're trying to not be any of that for this. So they're like, hey, all our oil's out, our quotas are up because I think they're seeing this, and then in the news this week. So again, the same like Bloomberg's and Wall Street Journals or whatever. Oh, Reuters. Oh, like oil is going to crash because they're whatever. The Saudis raised their OSP to Asia, and it got bid. I mean, that was it. So we're seeing very interesting things happening here, and those are in line with some of the stuff we're talking about in terms of potential debasement and money printing and so on, and lower rates, forced lower rates. And in terms of this cycle where, why would China and other East Asian countries be bidding for oil if you just look at, the narrative on oil and the current supply demand models versus this sort of chart and this sort of looking forward just a little in order to figure out what's next. So I think that's sort of the big piece. Everyone talks about it. Almost no one understands it. I don't know. I understand it. I at least got to talk to them and maybe have a hint at what might be going on.
No, I love that you added that in there. So jumping from oil to natural gas, I know our headline's natural gas. So let's talk about natural gas. So what are you seeing here? We were on with Michelle Schneider last week, just kind of chatting through natural gas. She's more short term, tactically trading. I know you're probably looking at it on a long term angle. So what are you seeing in natural gas, the sector, the stocks, whatever you're looking at today?
Well, can I ask first, what's the short-term view on natural gas? Because that could be good to know.
So
Yeah, so like this is like a multi-year bearish to bullish reversal pattern here in the natural gas futures. So 350 really seems like a big level to me. But more short term, I think three is a really big level. And, I don't think this is a top. I think this is just a continuation pattern here. So I really like natural gas futures against that $3 level. Um, that's just my 2 cents. But
that's the same thing Mish said, and same thing like she was looking at, which is reversal right here, probably headed higher real quickly. So, that's what I think my consensus is that too. I think the same thing as Sam does and Mish does is that this is probably not a top. Not to mention looking at if we're looking at fund flows, we're looking at commercials, we're looking at the positioning. Like I have no reason to think natural gas is going to head much lower here. I think it's probably higher in the short term, especially now. Another thing to think about is August is actually, even though like a lot of people would be like, oh, summer's bad months for natural gas. As you know, like, if you look at what everybody says about oil and you look at the seasonality of these things, most of the time, like they go, okay, well, summer's driving season, it's the best time for oil. And then, it's usually not. And then if you go to the winter time, that's usually some of the best months for just trading oil short term. And the same thing for natural gas. It's the opposite of what most people think, heating your homes in the winter. They go, actually, August, September is actually a really good time for natural gas. So just some seasonal stuff, but basically looking at probably natural gas hitting higher. So what are you seeing here on the fundamental side? Any of these stocks that you're looking at that you want to toss out, feel free to. If you're trying to hold them on for your members, feel free to do that as well.
Cool. Yeah, we just put out a thesis. Don't want to, excuse me, share that name publicly just yet. But okay, so here, sorry, 1 second.
You're good. I'm gonna put the your new post on my channel so people can check it out.
should post that in the YouTube chat as well, Jason.
I will do that.
That would be helpful.
Great.
Good ideas.
Okay, so what we're seeing is three things happening in natural gas fundamentally that have us extremely bullish. So one is for North America, there's a huge amount of LNG build out and data center build out. So they're building these giant liquefaction plants and pipelines from natural gas fields to the coast where they liquefy the natural gas and they ship it to Europe and Asia and various other places in the world. Honestly, it's sort of surprising when you see who imports it and what they're doing with it and stuff. It's sort of wild. There's places you would think that would export natural gas that actually end up importing liquefied natural gas. And similar to oil, people have talked about a glut in the LNG market for years, and it's massively undersupplied. And to the extent that there is a glut, it could force prices down a little. But the amount it could force prices down likely would be to a point that could support, let's say, $5 plus US natural gas or Henry Hub, which is what we're looking at. So, very, very supportive, even in this sort of like consensus bearish global LNG case. And it's pulling so much gas that it's going to be a giant struggle for the industry to grow production enough to meet that demand. Concurrently, we have this whole AI data center construction boom, along with a sort of secondary power boom for electric vehicles and various other sort of electrify everything stuff. And so we're having high power prices, which is leading to extra power burn generally. Right now, coal has mostly supplied that rather than natural gas for now, but we're sort of hitting the limit on that too. So more gas burn coming soon, both for AI data centers and for sort of general power demand. So that's on the demand side. It looks really great, and you'd need to have supply grow a lot in order to meet that demand. There's a problem. The problem is that one, there's been insufficient investment to be able to meet that supply. And then two, the wells that people are drilling are getting worse, not better, on a per foot basis. And so there's sort of, it's like the old thing about like the internet stocks where they would like, or like pets.com, they would like lose money on every purchase, but they try to make it up on volume. So if your wells are getting worse per foot, and so you're trying to make up for that by drilling longer wells, at some point you run out, and we'll see, like they've already, the engineers and mechanics and so on in the industry are brilliant, the chemists brilliant, and they've been able to solve all these problems, but there are physical limits to these things, and we're starting to hit these physical limits. And so we're going to get these limits soon, and that means that we're going to need much, much higher prices in order to induce more supply in order to meet this upcoming demand. And then this period of low prices has been hurting because there should have been more exploratory activity, and it's sort of like a mini version of the oil thesis for the US for the last like few years rather than the oil thesis being sort of global. So yeah, I mean, things look great from a demand perspective. They look concerning if you're a consumer, and great if you're a producer from a supply perspective. And then the one other concern, and there was one producer that I wanted to mention. I don't know if you guys pulled the chart for it. I don't own the stock. It's very famous because of the guy who controls it. It's Comstock with Jerry Jones. They just had a major sort of toe stub where they thought they were going to be this big incremental supplier of gas, and they're achieving some success in this new area, but it's taking longer and costing more, and their stock has gotten crushed. And so I think that message is that gas prices need to actually go even higher in order to make up for the costs and logistical issues of bringing on incremental supply. And it's sort of one of these fun things where you can see it in the fundamentals, and you can also see it in the stock chart. And so I thought for you guys, that'd be sort of a good one to show, where the more bullish gas you are, the more you want to see these sorts of charts of the producers where they're sort of failing to hit what they're supposed to hit. So the stock price is down, and maybe the gas price is down temporarily because the spot price isn't really that affected by what Comstock does day to day. But 2 years from now, it's going to matter a lot that it's taking them longer and costing them more in order to bring on West Haynesville gas.
No, it's interesting because when we're looking at natural gas and looking at these stocks, we are seeing a lot of them starting to show some relative strength. We're starting to see some of them starting to move. And just the copper miners are moving. Like, to me, it's the whole cycle is starting to kind of pick up. And this is something that is incredibly important. Like you said earlier, when we're looking at the small cap stocks compared to the large cap stocks, if we look at gold, gold moving, sometimes it tells you something, sometimes it doesn't tell you much. But what tells you the most is you're looking at the large cap gold miners, and now we're seeing the junior gold miners are outperforming. Sam has a great chart where he talks about over the last year that silver junior miners are actually outperforming the majors at the moment, which is very interesting. And so that's kind of telling us this cycle has legs. And now I think it's a time in the cycle where we're kind of get into more of this energy start sectors. Looking at uranium's looking great. CCJ is hitting new highs. The sector is looking good. I think it's near all time highs. XME, metals and mining, it's starting to move. So I think natural gas is probably up next. Oil is probably up next, and I think it's a good time to start getting ready for some of these moves. No, nobody has a crystal ball here, but telling you, like, hey, over time, these things have definitely a good fundamental picture. Technically, they look good. That's the best you get at trading, like, and you as a fund manager and me as a fund manager, we both know this. Like, there's no such thing. This is why we always preach risk management. This is why when Josh said I buy options, I buy them a small part of my account. Sir Josh is similar to me in his fund, where it's like 1% of my account is an options trade. It's a very small thing, but at the same time, like, if it can go 10x, it'll help out the fund quite a bit. So that's what we do. But at the end of the day, it's put as many things on your side as possible. Put the probabilities on your side, take the trade, risk manage properly, and over time, you'll make a lot more money. So, Josh, anything you want to end on? This has been a great conversation. I think people really enjoyed it. I think, we all learned a lot, even myself. So I think it was a lot of fun having you on. So anything you want to end on where people can find you, something else that you're looking at, whatever you're thinking about.
Sure, two things. So one, yeah, the junior miners ripping, that tells you, like I was saying, like that's where the supply is going to come from. But that supply and those new mines, that's where the demand is coming from for oil. And so it's just so exciting to see it it's what you look for. That's a real bull market for gold, that it's gone from the big producers to the smaller ones. I think that's coming for oil and for natural gas in a big way. And so, it's great to see. That's like what I've been seeing on some of these projects, and people don't see it yet. It's not in the supply demand models for oil. So very, very exciting, I think. Bisoninsights.info. We figured we really want to just make it about education and sharing sort of unique perspectives in the oil and gas space. And thank you guys for having me on. I really appreciate getting to see your different perspective, and it's good to get to chat with you.
Absolutely, man. Thanks for coming on. Anything you want
Thank
to
you,
add?
Josh. You are the man. I told you that before we got on this show, but seriously, guys, go check out his research. He's one of the best in the business. So thank you for
Thank you,
doing this,
Sam.
Josh.
Thanks for having me on.